Welcome everyone to our webinar regarding withdrawal liability and pensions. This is the fourth webinar in the 2021 Labor and Employment webinar series. Thank you for joining us, and we look forward to an interesting discussion today. Today's topic, as you can see, is going through withdrawal, avoiding, minimizing, and fighting withdrawal liability. This is just a bit about me. I'm Mark Trapp. I'm a partner in Conn Maciel Carey Chicago office. I practice labor and employment law, deal with litigation, dealing with collective bargaining, multi-employer pension plans, including withdrawal liability, and do a lot of employment-related litigation as well. The agenda we'll cover briefly. I'll try to be respectful of everybody's time today. This is set to last an hour, and we've got a lot of information to get in. The agenda is broken down into three broad components: avoiding withdrawal liability, mainly through business planning issues; minimizing withdrawal liability, also some to do with business planning; and then fighting or challenging withdrawal liability. Let's start off with business planning to avoid withdrawal liability. Just a little background about withdrawal liability. The Multi-Employer Pension Plan Amendments Act of 1980 is where withdrawal liability comes from. That act created withdrawal liability. And that's basically, a lot of folks just refer to it as an exit fee to cover unfunded vested benefits. If you think of a pension as conferring vested benefits, which most people do, then the amount of vested benefits which are unfunded are your unfunded vested benefits. A proportion of those is allocated to each participating employer if there's some portion that are unfunded. When you withdraw liability is essentially an exit fee to cover your proportionate share of the plan's unfunded vested benefits. That's just a general statement. There's a lot of qualifications to it, but we'll get into that as we go through the presentation today. Usually your proportion of the unfunded vested benefits are proportionate to your participation over time. A withdrawal is triggered by a reduction or a cessation of your obligation to contribute. It happens a variety of ways: a sale of a business, the closing down, you conduct a bunch of layoffs, or you shut down a unit or a particular facility, or bargain out of one or more collective bargaining agreements. You might get expelled by the plan sponsor. A lot of different ways. It focuses mainly on the legal obligation to contribute. And note this at the bottom of that slide here, that the mere failure to make contributions that are due under a collective bargaining agreement does not trigger a withdrawal. So just if you stop making the contributions for whatever reason, that by itself would not trigger a withdrawal, because you would still have the legal obligation under your collective bargaining agreement to make those contributions. We'll talk a little bit more about that as well. A couple different kinds of withdrawal liability, broadly speaking: a complete withdrawal, which occurs when an employer permanently ceases to have an obligation to contribute, or they cease all their covered operations under the plan. Like I mentioned before, that can come from closing down, a sale, the collectively bargained, that's negotiating out your termination from the fund. Decertification, if your union decertifies, that could trigger a withdrawal. And also expulsion, this adverse selection idea. I'll tell you just a bit more about that. Generally, plans have pretty wide authority to police themselves and are generally thought to have discretion to expel employers if there's an arrangement that's not in the interests of the plan. For example, say there's an agreement that requires contributions only for the most senior employees. They've been grandfathered in, and the new collective bargaining agreement does not require contributions for new employees. this would lead over time to the employees that are most likely to draw the benefits from the fund are the only ones for whom the employer is making contributions. Plans call this adverse selection, and a few of the plans have expressed policies that prohibit arrangements like this, and they'll act on it if they're aware, or they will make you change your agreement or risk expulsion. And expulsion could incur withdrawal liability as well. A partial withdrawal occurs in a couple different ways. There can be a 70% contribution decline from your high years, and there's a period to measure those high years. Again, you look at your history. You go back to 5 years before the 3-year testing period. During those 5 years, you take your 2 highest plan years contribution-wise and average those. That's sort of your high year. And then you measure each of these 3 years against that and see if there's a 70% contribution decline. That could result in a partial withdrawal. So if you had a sustained slowdown in your industry or in your contributions, that could trigger a partial withdrawal, even though you are still a participant in the plan. Second way that this could happen is where you cease to have an obligation to contribute under one, but not all of your collective bargaining agreements, and continue the work in the jurisdiction of the CBA, or you transfer the work to another location that's controlled by you, the employer. That's called a CBA takeout generally. And then the third possibility here is usually referred to as a facility takeout. This is where you cease to have an obligation to contribute at one, but not all of the facilities that you control as the employer, and continue the work at the facility. So sort of the key concept here for these CBA takeout and a facility takeout is this idea that you're continuing, that the work is continuing on a non-contributing basis. Work that was previously contributed for is now going to be continued on a non-contributing basis. So flowing from that thought is the idea that if you shut down a facility and you don't continue or transfer the work, that would not usually result in a partial withdrawal unless potentially it met this 70% contribution decline over a 3-year period. But if you just shut down a facility and continue contributing at your other facilities, and it doesn't trigger that substantial withdrawal over 3 years, the mere fact of shutting down the facility, as long as you're not continuing or transferring the work, would generally not result in a partial withdrawal. Let's talk about an important concept from a business planning perspective. This is a control group liability. The general principle under ERISA is that plans cannot reach the personal assets of owners or shareholders of a withdrawn employer. However, this control group liability provides a pretty, in some circumstances, pretty broad end run around that general principle of no personal liability. That's because withdrawal liability applies not just to the withdrawn employer itself, but also to other trades or businesses, and we'll talk about that phrase, but trades or businesses that are under the same umbrella of common control with the withdrawn employer. That results in joint and several liability of all those commonly controlled companies or entities, and the fund could go after any of those members of the control group to seek payment. You also need to watch out for so-called attribution rules, and I'll talk a little bit about those. And know this at the outset as well, that in this control group area, courts have held that businesses, the businesses in the control group don't need to be economically related to be within the same control group. So you might have one business that really has nothing to do with the business of the employer that's obligated to contribute under the collective bargaining agreement. But the key is whether or not it's commonly controlled. And we'll talk a little bit about how do you determine that. So let's see here. What is a trade or business? I told you we'd talk about that phrase. ERISA doesn't have a definition for trade or business, but the Seventh Circuit, which is a pretty prominent circuit in this area and withdrawal liability and under ERISA, and most other circuits too, I think follow the same sort of test in one form or another that was articulated by the IRS in a case called Grotzinger in the 1980s. This test asks whether the entity's activities are performed, one, for the primary purpose of income or profit, and two, with continuity and regularity. And we'll discuss that in a little bit more detail as well, but you could have a trade or business. I hope you pick up there. It doesn't matter whether it's incorporated or not. It could be a sole proprietorship or a partnership or something like that. But a lot of different things could be a trade or business under that two-pronged definition. Primary purpose of income or profit and with continuity and regularity. Now, there's a lot of case law out there that says this, and again, it's more of an exception than the rule, but it doesn't include income received as an employee or through passive investments, and the ones that's often mentioned is like hobbies. It does, however, and we'll get into more detail on this in the next slide and the slide after that as well. It extends to leasing activity, this idea of a trade or business, and earnings as an independent contractor. So, for example, the owner of a withdrawn company could expose his personal assets to recovery from the fund for a withdrawal liability if he or she leases property or equipment to the withdrawn company or third parties, even if it's unrelated to the withdrawn company, or earns income as a consultant. So maybe on a 1099 or something, that could be viewed as a trade or business as well. Let's get a little further into this leasing idea, because this is one that often comes up and that I've seen quite a bit. Here, this is again stems from the Seventh Circuit, but I believe it's applied in other circuits as well. But the Seventh Circuit is prominent here, and it calls it the leasing property rule. This rule, I've listed out a couple of the cases, and I found even a couple of more recent cases. This one here at the bottom, the Lee Lumber case, is just from last month. And the quote from that case was, renting property to a withdrawing employer is categorically a trade or business. And what often happens is that an owner will set up his business. He'll have his LLC or incorporation or whatever, and it'll be, let's say it's a trucking company. And the owner also owns the land or maybe the building. Let's say he owns the building where the trucking company has its operations. And he owns that building through a trust, a family trust, or maybe through a different LLC that's, Tom Jones LLC, Tom Jones Property LLC, something like that. And he owns Tom Jones Trucking, and he leases the building and the land to his trucking company. That could be a trade or business, and would be a trade or business under this leasing property rule that's applied by the Seventh Circuit. That is, if the owner is leasing his business the property on which the business sits, then that would make the property a property rental business, a building rental business, and that could be a trade or business, which could be liable for the withdrawal liability in the event that the withdrawn employer is not. So if Tom Jones Trucking goes out of business and the pension fund comes calling and Tom Jones Trucking says, gee, sorry, I don't have a dime, surely the pension fund is going to go after Tom Jones Property LLC and say, well, you look like you got some money there. That's a trade or business. You leased the building and the property to the withdrawn employer, so that's part of the same control group. See a couple other examples here on this page of that Hanna Brothers case from 2014. The related entity leased the tugboats to the withdrawn employer, so they leased equipment. And I guess you could do the same thing with, trucks or any other equipment like that. And then this one from last year, this Great Eyes Express Company. This was kind of an interesting one because the lease was rent-free, and there was no payments made for insurance or maintenance, utilities. They didn't claim anything on their taxes. And the court still said, too bad, that falls under the leasing property rule. So even where it was sort of an informal lease, doesn't even have to be papered up, and the courts could find that, and no money even has to change hands, and it could still be that come within the terms of the leasing property rule. So that's something to be aware of if you find yourself in that situation as an employer with an obligation to contribute to a pension plan. Here's a quote from another case, and you notice these are all from the Northern District of Illinois, which is here in Chicago where I am. But the principles are applicable elsewhere as a general rule as well. Here's the quote from this case. In sum, if an individual engages in a trade or business under common control with the withdrawing employer by leasing his property to the withdrawing employer, he is personally liable for payment of withdrawal liability. So that's a pretty broad statement and a scary statement for a lot of businesses, and that's why I put the exact quote on there. Basically, I want to sum up the principles here and the three points at the bottom of the slide. Where an individual owns the property on which a withdrawing employer conducts its operations, leases that property to the withdrawing employer, and 3, owns the withdrawing employer, that individual is personally liable for the payment of withdrawal liability incurred by the withdrawing employer. Consider that when you're making your business plans. Let's talk a little bit more about a controlled group. 2 or more organizations that are trades or businesses, which we just discussed, and then under common control. So let's talk about this idea of common control. Generally, this is entities, that is corporations, partnerships, sole proprietorships. I suppose it could even be an individual in the example that we just gave, that have an 80% overlap of direct or indirect ownership. Generally, common control falls into these 2 categories: parent subsidiary companies, which you probably can figure out. You know, it's usually the situation where one company owns 100% of its subsidiary. But then there's more complicated rules too. The second one is a brothers, sisters, as defined by the tax code. Those generally consist of 5 or fewer individuals, trusts or estates that satisfy an 80% common ownership test that I mentioned, and a 50% identical ownership test. There's also, as I mentioned on a couple slides back, there's these complicated attribution rules that, when applied, may attribute the ownership interest of one member, typically a spouse, a son, daughter, some sort of relation like that, where the Internal Revenue Service would assume some level of control or interrelationship. They attribute that ownership interest of one member to another. So it may not be that you could, put the property in the name of your spouse and completely avoid the control group issues because of these attribution rules. You've got to look into those pretty carefully. And as I noted before, the members of the control group are jointly and severally liable, and the courts have held that they don't have to be economically related. So this control group issue is a pretty big one to be aware of when you're thinking about withdrawal liability. Basically, because it expands the liability beyond the contributing employer. If you have the idea that this entity that's withdrawing and shutting down, perhaps, and liquidating, whatever, is the only entity with the obligation. So if they don't have any money at the end of the day, that's too bad for the fund. You want to make sure that there aren't any control group issues, because the members of the control group are jointly and severally liable. Pretty important to recognize. Other business planning issues, if you're going through a merger, a stock sale, reorganization, other changes in structure, maybe a spinoff, things like that, There's generally no withdrawal if the obligation to contribute continues. Those just in and of themselves won't trigger a withdrawal under the statute. However, an asset sale will trigger a withdrawal unless the parties comply with the requirements of the section 4204. And we'll talk about that a little bit here on this slide. So something to consider if you're selling in an asset sale, your business, or if you're purchasing. So if you're a purchaser or a seller, this is important to know for a couple of different reasons. Because the statute states that in a sale of assets, you will trigger a withdrawal unless you meet these conditions that I've set forth on this slide here. A bona fide arm's length transaction, that is, the sale is the result of a bona fide arm's length transaction with an unrelated party. That you're not, it's not just a sham transaction. That one's usually pretty easy to satisfy. The second is that the purchaser, the buyer here, has to have an obligation to contribute for substantially the same number of contribution base units. And we'll talk a little bit about that. That's if under the collective bargaining agreement, you contribute, you owe so much per day for each employee that works, or so much per hour. Hour is usually the most common one. That would be your contribution base unit. If you have to contribute for every hour that an employee works, for example, your contribution base unit is an hour. And the purchaser has to have substantially the same obligation to contribute for the same number of contribution base units. Substantially is subject to some interpretation. Most of the interpretations I've seen under ERISA say that substantially the same number is about 85%. Nothing says that specifically, but that's where the cases have usually come down, and that I would feel pretty relatively comfortable with, that if you have substantially the same number, it's about 85%. And that's so the purchaser has to continue the obligation of the seller for substantially the same number. They also have to post a bond there in the second requirement for 5 years. That obligation, I note, is generally determined at the time of the sale. So if the purchaser takes on substantially the same number of contribution base units, and that, let's say they buy the assets and they hire the same employees or something, and they're planning on continuing the same way, but then in year 2 or something, their business drops and they fall below that 85% level, that's usually not going to be of much concern. It's determined, did they take on substantially the same number of contribution base units at the time of sale? And the third requirement is that the seller has to agree, and this has to be included in the sales contract, written out in the sales contract, to secondary liability within the first 5 years after the sale if the purchaser defaults. So if you're a seller, you're thinking, wait a second, I'm going to be on the hook for 5 years after the sale? And the answer is yes, if you don't want to, if you're trying to avoid triggering the withdrawal liability through application of section 4204, that's the deal. The purchaser will be on the hook primarily, but if he withdrew, if that entity withdrew within 5 years after the sale and didn't pay the withdrawal liability, then the seller is secondarily liable, and that has to be in the contract. A couple other things about 4204, the buyer assumes 5 years of the seller's contributions history. Something that's interesting about that is that it might be that when the purchaser, if and when the purchaser withdraws thereafter, that that purchaser's withdrawal liability is actually less than the seller's. And you wonder why that would be the case. It may be because they've only taken 5 years of the history, where in a normal withdrawal situation, the fund looks back 10 years on the withdrawn employer and picks the 3 highest consecutive years out of those 10 for their contribution history. Here, the buyer has only taken on 5 years, and maybe if those 5 years were lower than the prior 5 years, the withdrawal liability could actually be less for the buyer than for the seller. If a buyer is purchasing without an explicit assumption under 4204, the section 4204 of ERISA that we're talking about, the buyer should analyze successorship, and we'll talk about that here in just a little bit, this doctrine of successorship. got a couple slides about that. You need to conduct thorough diligence to figure this out and figure out what you're going to do about this withdrawal liability. This is true for the buyer and the seller, but particularly a buyer, if they're taking on the withdrawal liability through application of this section, you want to factor that into the purchase price. If you're not, you want to make sure that it's covered and make sure that it's paid so that the fund doesn't come after you as a successor, which I said we'll talk about. And it's often the case that maybe the transaction isn't worth it. I mean, a lot of these entities with withdrawal liability hanging over their head are slightly less desirable than those that do not have that issue. Let's talk about successor liability here briefly. Funds are increasingly using this doctrine to go after asset purchasers. There's the general common law rule was that asset purchasers, all they're purchasing is assets. They're not purchasing the liability. That's sort of a standard common law rule, and it was the whole purpose for just purchasing the assets is that you don't want the liability. However, some of these cases that I've listed out here, you can see they're from more recent years, and in the Ninth Circuit, the Seventh Circuit, another one in the Ninth Circuit, the Sixth Circuit has also done this, and I think the Third Circuit. Most of the circuits have gone this way. If you have notice of the liability, if you're the buyer and you have notice of the liability prior to the sale, and there is sufficient evidence of the continuity of operations after the sale, and I put in the parenthetical, workforce, management, equipment, completion of work orders that were commenced by the seller, consistency of customers, factors like that, then the purchaser could actually be liable for the withdrawal liability as a successor to the withdrawn employer. And the way the funds view this generally is like, well, look, if you took over that business and you're holding yourself out as that business, basically, if you continued with the same equipment, you're using the same place, you're using the same address, you're filling their orders, you took on all their inventory, you kept all the same customers, you use the same name, the same phone number, all these indicate that you're the same employer. Well, then, and you had notice of liability prior to the sale, then they could come after you as a successor to pay that withdrawal liability if the withdrawn employer did not. The factors that the courts consider, I laid out a couple of them, but here they are in bullet point. You're using the same physical assets, equipment, building, real estate. You took over the customer base, continue the management, you hired the employees, you took other assets, their goodwill, their trademarks, you hold yourself out as operating the same business, then you might be on the hook. And like I said, it's a two-factor test. It's relatively easy to satisfy in a situation where, if a purchaser is buying out another company, may not think through all these issues and could end up on the hook for far more than they bargained. And the funds have been particularly aggressive in recent years in using successor liability to pursue withdrawal liability claims against asset purchasers. Some of these cases, like these cases that I mentioned here on this slide, have construed successor liability pretty broadly, and even the question at the bottom of this slide here, did the new enterprise have notice of the withdrawal liability? Some of the cases have found that if they do have notice, if a purchaser using reasonable care or diligence would have discovered the liability. And in that SARF case that I mentioned on the previous slide, the Seventh Circuit case from 2015, notice was construed very broadly. In that case, the Seventh Circuit basically relied on the doctrine of constructive notice. And in this Heavenly Hannah case here, Heavenly Hannah Hotels, they also relied on the idea of constructive notice and pointed out that when the buyer bought the hotel, they had a 4-person due diligence team, and they hired engineers to look at the roofs, to inspect for termites and to check all the conditions of the structure. And So the court said, well, you know, you as the buyer didn't rely on the seller's representation regarding termites, but you did rely on their representation that they made as to withdrawal liability. They said, well, that's unreasonable. You know, that you just carved out and accepted what they said as withdrawal liability. So that's pretty broad and something that you need to consider, certainly if you're looking at purchasing assets or another business, that you could be on the hook as a successor. Let's talk about some key points here for business planning. Make sure you conduct the due diligence in any purchase or sale. Watch out for successorship. Like I said, make sure you account for that liability. And also, just as a general business planning principle, conduct careful estate and business planning. The collective bargaining agreement I didn't get into too much, but you want to make sure whether you're buying or selling or even just running your own business, make sure that your contributions are in accordance with the collective bargaining agreement. There may be other agreements, you know, a signed participation agreement that you sign as well. Make sure you know the universe of documents that bind you to the fund, and then make sure, you know, running your own little self-audit or something, that you're only making contributions that are consistent with what you're called to make under the collective bargaining agreement. You may be making contributions that are not called for. And from the fund perspective, if they don't check that out, then later on when you withdraw, they may think that those contributions were actually legally obligated, and that could boost your withdrawal liability as well. Not to mention the money that you're spending, you know, paying that you don't have to pay. And that sometimes happens when you see, you know, vacation or leave. Sometimes the collective bargaining agreement will require only contributions for hours actually worked rather than, you know, hours paid. There's a big difference there. And if you're paying for all hours, even vacation, leave, you know, PTO, but your contract says that you only need to pay for hours worked, then you're losing money right now, and it could impact your withdrawal liability determination down the road. Also for overtime, you know, some contribution or some collective bargaining agreements have caps on hours, and say you have to pay 40 hours a week, and you know, maybe you're contributing for overtime hours too, and maybe you don't need to. Maybe the work that some guys are doing is outside the scope of work that's spelled out in the collective bargaining agreement. Maybe they're working in certain instances outside the jurisdiction of the collective bargaining agreement, or they're performing tasks that are not covered. Figure all that out and make sure that you're not losing money right now. And also, this other note, I put, don't blindly accept rate increases. Ensure proper language under the MPRA, and I'll circle back to that here in a little bit, but let's make a note of that. When you're negotiating contracts, don't blindly accept the rate increases that are dictated on high, at least without dotting some I's and crossing some T's, and we'll talk about that. And then this, reiterate this idea of control group. Make sure you're paying attention to leased property and equipment, and that you know your control group issues as well. Finally, it's always good advice here for business planning. Know your liability. Send out an estimate information request. You're entitled to get annual estimates to know the fund condition, your withdrawal liability, all that kind of stuff. Get their arbitration decisions that you can see and look through and analyze. Under ERISA 101L, you can get your estimated amount of withdrawal liability. They're supposed to tell you how the liability was determined, tell their actuarial assumptions and methods, give you the data that they have on employer contributions, unfunded vested benefits, and annual changes. And then this key here is the application of any limitations. Now we'll circle back to that later on too. There's a 20-year cap on withdrawal liability. Oftentimes I've seen when you ask a multi-employer fund for your withdrawal liability estimate, they'll give you a number, but it actually turns out to not be withdrawal liability. It could be your unfunded vested benefits. And there's a big difference in those concepts, primarily due to the application of the limitation, which we'll discuss, the 20-year payment cap. And like I said, we'll come back to that. But just know, sometimes they'll give you that estimate and you'll think, holy cow, this is a huge amount. And it is, it usually is, but that you may not owe that full amount as withdrawal liability. So even though they're supposed to give you that, they often don't. So just bear that in mind. You can get it once every 12 months. They have to give it to you within 180 days. Let's talk about minimizing withdrawal liability. How do you calculate, how does a fund calculate withdrawal liability? Well, like I mentioned early on, they take the plan's unfunded vested benefits and allocate a portion of that to the employer. It's usually relative to your to the employer's historic level of contributions. This gets a little bit more into what I was just talking about the payment cap. The withdrawal liability is payable in level annual installments pursuant to a statutory formula, and I'll tell you that formula here in a little bit. And then there's some limitations on it that we'll discuss. Some of these relief provisions to soften the impact, the de minimis reduction. If it's, we're talking about a substantial amount of money when $50,000 to $150,000 is sort of written off by the statute as de minimis, as minimal. So that's one reduction. If you just had a de minimis amount, then you don't even have to pay that. The 20-year payment cap is a key that we'll circle back to. And then the sale of assets limitation and the insolvency limitation are both spelled out in section 4205 of ERISA. And I'll tell you a little bit more about those too in these slides. So here's section 4205. Limitations, they can be pretty substantial savings. Employers need to consider these. The sale of assets. Now, this is not, I'm sorry, this should say section 4225 limitations. I'm sorry, 4225. Because it's not to be confused with section 4204, that sale of assets provision that we talked about before. This one is 4225. And if in a bona fide sale of all or substantially all of the employer's assets, this is spelled out on the slide, in an arm's length transaction, the unfunded vested benefits allocable to the employer will not exceed a portion of the liquidation or dissolution value of the employer. And if you look up section 4225 of ERISA, you'll even see a little chart there in the statute. And it sets forth like the liquidation or dissolution value of the employer. So if you're shutting down and closing your doors and liquidating, there's a chart there that limits the allocable unfunded vested benefits that are attributable to you as the withdrawn employer. And it can be a pretty substantial markdown. So that's something to consider. And a lot of employers don't. They just close the doors. And maybe if they have a little more planning, they could save some money. Same with the insolvency and liquidation provisions. Those are also spelled out in section 4225. And if the employer is insolvent and undergoing liquidation, then there's some substantial savings available there. Take a look at that if you're considering shutting down. The timing is also very important in minimizing withdrawal liability. Under ERISA, the date of a complete withdrawal is set forth under statute. It's the date of the cessation of the obligation to contribute, and it can make a huge difference. You want to check when your collective bargaining agreement expires here, and also know the fund rules and the fund plan year. Sometimes the plan, often a plan year is consistent with the calendar year, but it's also the case that pretty often plan years run from February 1st to January 31st, or May 1st to April 30th each year. The plan year can be different from the calendar year. And because withdrawal liability is calculated on a plan year basis, the timing of your withdrawal can make a huge difference. I had one case one time where actually the employer was expelled from the fund. I told you how that can happen. And this employer was expelled, and the expulsion was, quote, effective as of January 1st. Well, the plan year was consistent with the calendar year, which ran from, obviously runs from January 1 to December 31. And because our expulsion was effective January 1st, that got the employer into the next plan year, and it made a multi-million-dollar difference in the withdrawal liability. And we ultimately settled that case for a lot less money because of that, the date of the expulsion. I suppose they could have kicked us out the day before, December 31st, and done much better for themselves, but they didn't. And so it makes a big difference. And remember, you only look back 10 years when you're calculating the withdrawal liability, and your high year contribution years may fall off year over year. And so if you click over into that next year, if your best year was 10 years ago and it falls off, well, that impacts your annual payment and can significantly impact the amount that you pay for withdrawal liability. So just bear in mind the timing is quite important. Let's talk a little bit about how you calculate your payment. Remember, I said it's payable in level annual installments. This is just the basic contribution here. It's pretty, it's third grade math, maybe not even that. Take your contribution base units, which I said is the amount which you're obligated to contribute for. So it's either hours or, a week or a month. But if you're, most often it's hours, your collective bargaining agreement will say you have to contribute, $3 per hour worked by an employee under this agreement. Get your contribution base units, not the amount of money that you contributed. This is distinct. It's the number of units, the number of hours, the number of days, whatever it was. Look back the last 10 years and what your contribution base units were for each of those 10 years. Then get your contribution rate during those 10 years. The 10 years, and you see I put in parenthetical there, don't include the current year in your contribution base units, but do include it in the contribution rates. And that just means your contribution rate that you're paying now is almost surely the highest rate that you've contributed. And that's what they're looking for, is the highest rate in the last 10 years. That's probably what you're contributing now, and you include that. That's in your current year. But in the contribution base units, you look for every year except for the current one. The 10 years preceding this year, look at that. Then the annual payment is 1 times 2. Your highest CBUs, your highest contribution base units for 3 consecutive years. They have to be consecutive. You don't pick out cherry pick the 3 highest. It's 3 consecutive years out of that 10-year period that you're looking back, and you multiply. You take those 3 consecutive years and average them. So divide those 3 consecutive years by 3, and that's your highest year for contribution base units, your average. You multiply that number by the highest rate, and that's your annual payment. Pretty simple. Then the 20-year cap comes into effect because they can only make you pay that level annual amount for 20 years. You can also, you have the right to prepay under the statute and pay it at present value. There's some argument. Actually, there's quite a bit of argument from the funds as to what the discount rate is and what the present value is, but just know that you have the statutory right to prepay as well. Now, this goes along with what we were just talking about. Under the MPRA, which was on the prior slide, the Multiemployer Pension Reform Act. This was passed in 2014, and part of that act said that increases in contribution rates that are required or made in order to enable the plan to meet the requirement of a funding improvement plan or a rehabilitation plan. Those are required when your plan is in critical status. They have to come up with a funding improvement plan or rehabilitation plan. And under those, if they say, well, you have to contribute X dollars under this rehabilitation plan, those increases shall be disregarded in determining 2 things. 1, the allocation of the unfunded vested benefits, and 2, the highest contribution rate. Now, if you're following along closely, you probably recognize that, hey, wait a second. That gives you a chance to maybe get out of the plan with less resistance. Now, some of this may be taken away by the impact of this American Recovery Plan, which I'll talk about here at the very end of this. But those increases should not count against you for purposes of determining your highest contribution rate, which is a key factor in your withdrawal liability. That means if your high years, your high CBU years are dropping off as each year rolls by, and your contribution rate is the increases are not counting against you, then your annual payment should be going down, and that can decrease your withdrawal liability. That's something very much to be paid attention to. Now, the PBGC just earlier this year finalized this rule that, quote, simplifies withdrawal liability calculations. And I won't bore you too much with this, but in their proposed rule, they had included this idea that a quote benefit bearing increase, which is what the funds call some of these contribution increases that I believe should be discarded and disregarded when you're calculating withdrawal liability pursuant to the Multi-Employer Pension Reform Act. They were saying, well, if it's a benefit bearing increase, that can be included in the calculation of the highest contribution rate. That was obviously a big deal because that could increase your annual payment. Well, several of us filed comments against it, and I think the PBGC backed down at least somewhat. They dropped some of this problematic language from their regulation, but they noted that the final rule does not provide further interpretation beyond the statutory language. So I don't know if funds are going to stick with this idea that they can use these contribution increases against you because they're supposedly benefit bearing, but I think they've got a tough row to hoe there under the statutory language, and just know that the PBGC was citing, well, I guess that's the wrong way to say it, but anyway, there was some problematic language in the proposed regulation, and we'll see what becomes of that. Now let's talk just briefly about the impact of what I would say COVID shutdowns, or maybe COVID has caused you to have a slowdown in your business, or maybe even shutdown. If you close down or sell, you could trigger a withdrawal, obviously. We'll discuss in the next section some ways to avoid things like that. Remember partial withdrawals. Remember I said there's a 70% decline. Has to be over 3 years, so just pay attention. Like if you've had a business that's suffered a substantial reduction in contributions, you need to pay attention and make sure that you're not going to inadvertently somehow trigger a withdrawal. Remember that the withdrawal, though, turns on the obligation, the legal obligation to contribute. And that means that even if you have shut down or been forced to shut down, you still have the legal obligation to contribute for hours worked. Well, the fact that no hours were worked doesn't mean that you won't have that legal obligation when hours are worked again. So even if you've been shut down, unless you're permanently shutting down and closing your doors forever, that fact that you've been temporarily shut down due to this should not in and of itself trigger any sort of a withdrawal. But bear in mind the timing of withdrawal liability if you did decide to permanently shut down, as I already discussed. Let's talk lastly here. It looks like we've got about 12 minutes left. Let's talk about fighting withdrawal liability. If you're challenging an assessment and when you shut down, they just send you an assessment. You get a letter in the mail that says you owe us, X million dollars for this withdrawal. Just remember, arbitration reigns supreme. I call it a home game for the fund. Things are the rules and the playing field here is pretty slanted their way. But you have to resolve things through arbitration. So there's some procedural stuff that you need to know. First, you have to go to arbitration. And there's a couple of hoops you have to jump through to get to arbitration. And those not familiar with it end up getting stung. The statute says that any dispute between an employer and the plan sponsor of a multi-employer plan concerning a withdrawal liability determination shall be resolved through arbitration. So if you don't jump through these hoops and get to arbitration, you may have a very good argument, but guess what? You waived it because you didn't jump through these hoops. So just make sure that when you trigger a withdrawal, you're paying attention to it and you pay attention to these procedural niceties and deadlines. First off, from the assessment you see here, you have to make interim payments. I'll talk more about that. Those begin no later than 60 days from your receipt of the assessment. That's true even if you're challenging it. You file a so-called request for review, which is a written letter back to the fund. There's some opinion out there that maybe you could do it orally, but probably the best practice is to do it in writing so that you've got something to point to. You have 90 days from your receipt of the assessment to do that. If you don't do that, you can't initiate arbitration. And that's what I was saying. So you need to file this request for review or else you're shooting yourself in the foot. After you send the request for review, the arbitration window opens 60 days after the earlier of either the fund response to your request for review or 120 days. If the fund doesn't respond, and often they don't, to your request for review, then you need to be paying attention because 120 days after you served them with that request for review, your 60-day arbitration window opens. And if you're not paying attention and it opens and you don't know it, and the 60 days runs, guess what? You missed your deadline to initiate arbitration, and that could be bad news for you. The pay now, dispute later, that's sort of the phrase that's used in the case law. Like I said, when they send you an assessment, you have to start making those payments, whether you like it or not, and whether you're challenging it or not. They'll give you a schedule of payments, and you've got to start making those payments, even though you're fighting it. And even though you're jumping through the right procedural hoops, you still have to do it. That's what's referred to as pay now, dispute later. And it's very different from normal litigation. There's also a default under the statute. Like if you're supposed to make these payments and you don't, they send you a notice to cure, and you have 60 days to cure that. And if you don't, then they can accelerate the entire amount due. Some of these funds try to claim that they get the entire unfunded vested benefits in a default situation. I think there's exactly zero support for that under the statute, but nonetheless, it doesn't stop them from claiming it. And in some instances where they don't have anybody arguing otherwise on the other side, they actually get away with it. But you need to pay attention to that so you don't end up in a situation where the fund is trying to take advantage of you, more advantage than the statute allows them, which is pretty substantial in and of itself. So this default concept I was just mentioning, when you don't make those payments, they can bring a lawsuit to collect those delinquent contributions. And if you don't cure it within 60 days, they'll try to get the entire amount. And under the statute, they actually are entitled to get the entire amount of the withdrawal liability. So whatever they've assessed you under that 20-year payment schedule, they can accelerate. They can't go beyond that, but like I said, some of them do. Let's talk briefly about the payment of filing fees. There was a big to-do several years ago, which we were in the middle of, about these payment of filing fees. I said that the statute requires that you arbitrate these things before you to raise your challenges initially through arbitration. And the AAA, the American Arbitration Association, increased its rates from $650 to a schedule that went up to something like $70,000 filing fee to contest your withdrawal liability, which in my view was completely ridiculous. And even in a typical withdrawal liability case, involving several $1 million, the fees were $8,000, $12,000, $13,000 just as a filing fee. And I felt like that was ridiculous. Others did too, well, those who were paying it, because think about it. Who's going to pay to initiate arbitration? The employer. The fund wins if you don't initiate arbitration, as I already covered. So they have no incentive to go to arbitration. They have no incentive to pay the filing fee. So guess what? The employer was always stuck with this ridiculous filing fee. Well, some complaints were raised, and anyway, the PBGC finally, just a year and a half ago, approved the AAA's new rules, but reduced their filing fees down to a more fair $2,500 to $5,000, and said it has to be split, so they've got to pay their fair share. I still don't think that they should be entitled to force you to pay anything to initiate arbitration, but at least this is a little more within the realm of reason. And you also have protected right to help select the arbitrator and participate on that with your consent. Recent decisions. So some of the things that you litigate in these assessments are the actuarial assumptions. Remember I talked about how the interest rates can make a big difference. There's one from the Second Circuit last year, this Metz Culinary Management. The interest rates that the funds use have a huge impact on the amount of the unfunded vested benefits, and hence your allocable portion of the unfunded vested benefits. These two decisions are ones you should become familiar with if you're looking at challenging that aspect of a withdrawal assessment, because what the funds have done in more recent years is they'll have their own funding rate that they use to say, well, we assume that our fund is going to grow at 7.5%, and they use that for their actuarial assumptions. But then when you withdraw, they say, well, we're using the Segal blend, which is this actuarial outfit, pretty well known and respected, but they've come up with what they call the Segal blend, which utilizes, I don't know exactly what, I don't remember, but some of the PBGC pension benefit guarantee corporation rates and some of their own actuarial assumptions, and they use a different rate for the withdrawn employers, and it makes a massive difference on the amount of withdrawal liability. And there's been conflicting decisions on that. A couple of these are this soft co-erectors case was appealed, I think, to the Sixth Circuit, and that's being briefed and argued here right now. And another case has come out in the DC Circuit or in the Fourth Circuit, I think, that's dealing with these interest rates. That an opinion is expected pretty soon. So pay attention to those. Another potentially big issue is dealing with these credits. If you've had if you've had a partial withdrawal and then followed by a complete withdrawal or by another partial, even, you get a credit under the statute for the amount of that prior partial withdrawal. This Ninth Circuit opinion from late 2018, this GCIU Employer Retirement Fund versus Quad Graphics, completely, in my view, butchered the statute and overlooked a very fundamental, basic difference under the statute between unfunded vested benefits and withdrawal liability. And it's a huge issue. There's other cases being brought in the wake of that. I think that if you have a prior partial and then you're following it with another partial or a complete, you need to look into this issue very carefully, because I think this Ninth Circuit opinion is provably wrong and directly contradicts the words of the statute. And so this is a big one that you need to take a look at if you're fighting against a fund that has reduced or eliminated your credit by applying it improperly to unfunded vested benefits. Now I'll close here by talking about this this recent American Rescue Plan Act of 2021. This was just recently signed by Joe Biden last month. You've heard of it, the 1.9 trillion ARPA, the ARPA. What you may not have heard is that it provides 80 some odd billion dollars to these severely underfunded multi-employer pension plans. And that's just what they estimate. My instinct is that, you know, once all this money is getting thrown around the way that it is, there's going to be a lot more than $80 billion claimed, but I guess we'll see. But really what they've done here is they're paying the retirements for all these participants in these underfunded multi-employer pension plans. They agree to pay all the accrued benefits for the retirees through plan years 2051. That's 30 years from now. The funds have no obligation to repay those funds, and the amount that is allocated to these funds through the PBGC, quote, shall not be capped. It's basically a blank check written to these pension plans. Now, some of you on the call may be thinking, well, good, that means we won't have any withdrawal liability. Well, I'll touch on that in a second. It's easy money, and they're looking back. They're giving them a single lump sum payment. They equal to the amount necessary to fund all the accrued benefits for the next 30 years. And they're requiring the plans to reinstate benefits that were suspended under the Multi-Employer Pension Reform Act of 2014 and any benefits that were previously cut. And they're paying those retirees those full amounts of the suspended benefits. It's pretty remarkable that this was not more broadly known before it was tucked in there. Now let's talk about how this impacts you, because you may say, well, good, now they're going to be fully funded. So as an employer, I don't have to worry anymore about those unfunded vested benefits. So thank heavens, there goes my withdrawal liability. Well, no, maybe not really. The impact on withdrawal liability is a little bit murky here. And really, I suspect that the employers aren't going to see any relief out of this. The House version of the statute that passed the House included this, and this just shows you where they were coming from. Look at this quote. An employer's withdrawal liability for purposes of this title shall be calculated without taking into account special financial assistance received under this section until the plan year beginning 15 calendar years after the effective date of the special financial assistance. Now just think that through. When they passed it in the House, they specifically said, we're giving all these pension plans this money, But you as an employer have to pretend that we're not giving them this money for the next 15 years. And if you withdraw in the next 15 years, you're going to pay withdrawal liability that pretends that they still have all these unfunded vested benefits, even though we've paid them through 2051. Well, when it got to the Senate parliamentarian said that language couldn't be included in the bill because it was passed under reconciliation procedures to avoid any filibuster. But so you think, well, good, they took that language out. That means we're good. Well, maybe, we'll see, because the final act that the Senate passed and that President Biden signed authorizes the Pension Benefit Guaranty Corporation to impose reasonable conditions relating to, quote, reductions in employer contribution rates and, here we go, withdrawal liability. We'll have to see what the PBGC does through their guidance or regulations, but many observers suspect that they're going to do what the House wanted to do, and that they're going to say that if you get out in the next 10 years or 15 years, you have to pretend that all this money was not given to the funds. I don't know. We should see in the next couple of months, but keep an eye on that because it will have obviously a huge impact on your potential liability. That's all I've got. Thank you for attending this. Thank you for participating in the Conn Maciel Carey webinar series. We hope you enjoyed it. Thank you very much. If you've had any questions, then I will reach out to you about those, or you can reach out to me at the information that's here on the screen. Thanks again. Have a good day. Goodbye.